It's Monday, May 11th. Welcome to MarketFoolery. I'm Chris Hill. Joining me today from another state, because that's how we're rolling these days, it's Ron Gross. Good to see you, my friend.
Good to see you, Chris. How are you?
I am doing pretty well. We've got some earnings. We've got some, I don't want to get my hopes up, but we've got some encouraging news on the health front.
Encouraging is the right word. Exciting, yes.
Yeah, we're going to dip into the full mailbag too, but we're going to start with Marriott because Marriott International net income in the first quarter a year ago was $375 million. And this year, it's $31 million.
It's still profitable.
It is still profitable. Marriott is also laying off tens of thousands of people. What do you see when you look at a massive hotel company like Marriott?
Pain. And you know what? This one hits kind of close to home because they're headquartered out of Bethesda, where I live. So I actually, can put faces to furloughed workers. So it's tough, man. The stock reflects how bad it is, down 42% this year. Revenue per room, we like to call it RevPAR, down 22.5% for the quarter, which was down about 20% in North America, down 30% outside North America. Now, that's not even that bad, because when you look at April, RevPAR was down 90%, but that's not reflected in these numbers because the quarter ended at the end of March. But the pain was really, really, really significant in April. 25% of Marriott's 7,400 hotels are closed. A little bit of bright spot. They think maybe China is recovering somewhat. Occupancy there hit 25% in April. I think it's fascinating that we consider 25% to be somewhat encouraging. As you noted, the numbers are just devastating. Adjusted operating income, $192 million. For the quarter, down from $655 million in last year's first quarter. So then, we got to look at the balance sheet. How bad is this, and how much danger could they be in? Debt of $12 billion, cash of only $1.8 billion. So they went back to the markets, which I think was wise. Raised another $2.5 billion through debt issuances to kind of shore up that balance sheet. Interestingly, they actually bought some stock back, $150 million of stock back during the quarter before they said, well, maybe not. We should halt this, cancel the dividend as well, preserve our cash because we don't know when this is going to get better. So that's wise. As I mentioned earlier, furloughing tens of thousands of hotel staff, 2/3 of their corporate workers. I believe there are 4,000 or so of those in total, furloughing about 2/3 of them. So they're just in hunker down mode, going to wait this out. Traditionally a very strong company and traditionally a very popular company to work for, always on the list of great companies to work for. This is just an exogenous hit to their business that they're going to just have to wait out. And they'll come back, but we just can't predict exactly when this starts to firm up.
You look at the stock, it's down about 5% today. It's basically cut in half since the beginning of the year. But as you said, historically, this is a strong company. This is one of, if not the top performers in their industry. I don't know. I could see one scenario where we look back and a year from now and we say, oh yeah, that was the time to buy Marriott when the stock was cut in half, because they did talk a little bit about how, as you mentioned, the numbers in China, which are not great numbers, but they're certainly higher than they were. The company talked about demand in most of the rest of the world stabilizing. So the challenge for Marriott and all these hotel companies is, how do they demonstrate to people that they're completely safe walking into the hotel rooms?
Right.
And I think if they can do that, then we see demand going up.
For sure. And when do antigen testing, we'll talk about that a little bit later, help. Certainly vaccines will help. The vaccines will be the game changer for people starting to travel again. And so whether that's end of this year, I don't know, optimistic, next year, more realistic perhaps. But I mentioned on the radio show last week, Jeremy Siegel, I think correctly, said that 90% of a company's value is the cash flows that it generates after the next 12 months, right? So thinking about a company and a stock and a valuation like Marriott, the next 12 months, pain, but the rest of the Marriott's life, hopefully, God willing, is going to be more normal. Now, the next 12 months are very important. They make up 10% of a valuation because the near-term cash flows are almost in present value state as is, and you're discounting future cash flows back rather significantly. But if you believe in Marriott, you believe its balance sheet is going to withstand this, you're right. It's probably a time where we'll look back and be, boy, I could have owned Marriott at $87 a share, even if it goes to 75 or 70 or, if we can't call the bottom. 5 years from now, 10 years from now, I don't see how owning Marriott at $87 is not a good buy.
Under Armour shares are down 10% today. First quarter revenue for Under Armour down nearly 25%. And coming into this year, CEO Patrick Frisk, who's new on the job, he was all about the turnaround and executing his plan for the turnaround. And that bar is so much higher for Frisk and the team at Under Armour.
It's brutal. He came on, I think, January, right? I mean, it's literally just came into a storm. And as you say, it's not like Under Armour was firing on all cylinders in the first place. They had a rather significant restructuring program in place to kind of better align costs to where they see the business at the moment. And then this hit, and then, just so all bets are off. North America, which is 65% of sales, saw 28% reduction in revenue, and international was down 12%. Direct to consumer down 14%, wholesale down 28%. Any way you slice these numbers, they're just bad. They have previously announced layoffs, extended their store closings. They withdrew their forecast for the year, as most companies have. They lost $590 million for the quarter, if memory serves me correct. So, this is not going well amidst an already tough restructuring. So again, we always have to turn to the balance sheet and see how bad is this. The balance sheet is relatively okay. $1 billion in costs, about $1.2 billion in debt, kind of net neutral there. But business is weak, and you can contrast that with a company like Nike, who also is not gangbusters in this environment, but still the digital growth at Nike of 36%. Revenue is actually up for the quarter for Nike. Under Armour stock down almost 60% year to date. Nike's down only 12%, and that's a reflection that the businesses are just very different. And Nike's is much stronger. So UA, I didn't like it before the pandemic. I thought it was problematic, and I'm certainly even more wary now.
And there are, the old saying, there's enough blame to go around. There are enough mistakes that Under Armour has made over the past, call it 5-6 years. But when you talk about the e-commerce sales for Under Armour, I can't help but think about the decision that Kevin Plank made years ago to invest, I think it was $700 million, buying a connected fitness company of something like, and you think about a decision like that, and if instead the decision was, we're going to invest $700 million in a robust e-commerce platform, because those are decisions that Nike and Adidas have made, and that's part of why both those companies are in better shape financially than Under Armour.
Yeah, and I mean, we're playing armchair quarterback, but I think that's absolutely right. Like years ago, Nike sitting around the conference room table, hey, should we double down on our relationship with Foot Locker, or should we go multi-channel and really go direct to the consumer? And luckily for them, they made the right choice there. Bad for Foot Locker, obviously. But it's all about capital allocation and kind of looking into the future and kind of skating to the puck. Skating to where the puck will be, and Under Armour has not done a good job in that sense.
Well, and similar to Marriott talking about the rest of the world and demand stabilizing. With Under Armour, one of the things they talked about was their locations in China, that basically all of them have reopened. And now we get to see over the next couple of months, what does that traffic look like? Does it provide a blueprint to stores in the U.S.? If you're looking for glimmers of hope, that might be it with Under Armour.
Right, but then you'll just be back to their normal restructuring, right? And then back to where Patrick Frisk thought he was back in January, which was not an easy thing to be tackling. We'll keep an eye on it for sure. It's an important company, and we've talked about it a lot in Fooldom for years and years. So we'll keep an eye, but they've got some work to do.
Shares of Quidel, which is a company I'd never heard of until this morning. That's right, Quidel. Quidel. Shares up 25% this morning after the company got emergency approval from the FDA to distribute a new type of COVID-19 antigen test. And this test is designed for very rapid detection of the virus. This seems obviously great for shareholders, but this also seems promising for everyone in our country.
Yeah, look at that stock chart, or as they say in Boston, that stack chat. It's unbelievable. I mean, it's very exciting, and we won't pretend to be experts here because I was not familiar with this company either. But the fact that it's a quick test, the fact that it appears to be 85% at least accurate, the fact that it utilizes machines that already have an installed base in doctors' offices, about 40,000 of these Sophia machines, that's the brand name, Sophia machines, are already in doctors' offices. I think that bodes pretty well in terms of getting these tests directly to folks. And the fact that the FDA authorizes the emergency authorization means, they agree as well. And this is pretty exciting stuff. The test actually, it's a little bit different because from my understanding, it looks for actual chunks of the virus itself when checking out antigens. But again, if we talk too much about the science, I'll be making it up, and I certainly don't want to do that. But for all of us, for the economy, for the health crisis, it's going to be things like this, and then the eventual vaccine that get us back to some kind of new normal.
I watched a clip with Scott Gottlieb, the former director of the FDA, and the analogy, when he talked about how this test worked, it reminded me a little bit of a strep test. If you've ever had a strep test, and they can do sort of a quick version of it where they get the results, in 5-10 minutes, and 8 times out of 10, 9 times out of 10, that's the one. That's all you need. And then 10 to 15% of the time, it's like, no, actually, we need the more robust testing where we send it away and then we get the results, that sort of thing. But
and even that's probably only 24 hours, which is not too bad.
Right, exactly. Yeah. So this is great for Quidel, great for the shareholders, and if this is a test that can, because as we've talked about before, yes, we want a vaccine, but before that, it's all about the testing, and we got to be able to test as many people as possible, as quickly as possible. We're going to see that with businesses as offices attempt to reopen, and this could be part of the solution.
Yeah, for sure. I mean, the right now just taking people's temperatures, I don't think that gets us where we need to be in terms of getting back to business. We need to see who has antigens, who doesn't, contact tracing, all the same things we hear all the time. Testing, contact tracing, really important until we get to over that hump and get to the vaccine, as you said.
Our email address is marketfoolery@fool.com. Question from George Demakos, who writes, I am new to your stock advisor service. Tom and David Gardner always talk about buying 15 stocks. I have $6,000 to play with. Do you advise splitting the $6,000 up into 15 different stocks? Also, when you guys recommend stocks like Netflix and Amazon, does it make sense to buy Amazon at such a high price? I'd only be able to buy 2.5 shares. Does that really make any sense?
Good question.
I mean, it's a good point because, I think where Amazon stock price is, $6,000 probably gets you 2.5 shares.
Right. So first of all, George, welcome to Stock Advisor. I'm great that you're starting to invest. With respect to the 15 stock guidance that you often hear us talk about, I won't speak for Tom and Dave, but I'll give you my thoughts on that. It doesn't have to be immediate. It's something aspirational. It's something we'd like to see you build to, so you're diversified across a number of different stocks, hopefully a number of different sectors, hopefully a number different types of sizes of companies, market capitalizations. So you can get there over time. You don't need to feel that you need to do that immediately. And also, don't be afraid for some of that positions, one chunk of that 15 to be an index fund, which will get you even more instant diversification. So maybe start with 5 or 10 right now. Take your $6,000. He said he's going to play with it. This is not about playing. This is serious business, but definitely have some fun with it and invest for the long term for sure. Start with 5 or 10 and divide the 6,000 across that. It doesn't matter how much of any one company you buy. So the higher price stocks like Amazon, obviously, it can be rather daunting. If you have a broker that will allow you to buy fractional shares, that's even better because you can take $500 and buy $500 worth of Amazon and get a fractional share there. It's not about the number of shares you own. It's the amount of cash that you put towards a stock. So never focus on the number of shares. Just focus on the amount of capital you're investing in a company. Start now. Now's a great time to start, I think, in terms of pricing and where we'll be hopefully 5 or 10 years down the road. Start with 5 or 10, build towards 15, and you're on your way.
You know, speaking of index funds, as you mentioned, one thing I was thinking about this morning, because I've got an S&P 500 index fund, and looking at how the market is going so far this year and how it's probably going to go for the next year and a half, I might look into just putting a little bit of money into a NASDAQ index of some sort.
NASDAQ is positive for the year,
right.
which is fascinating, right? The market's being led, as it has been quite a bit over the years lately, by some of the large technology leaders. NASDAQ typically thought of as a home for technology companies. And so many of them are actually up this year. So when we think of companies being down 10, 20%, you can point to a number of companies that trade on the NASDAQ that are actually up. Certainly nothing wrong. A QQQ is a typical kind of a NASDAQ ETF, exchange-traded fund. Always great to have exposure. I personally have exposure to the S&P 500, the Russell 2000, which are small-cap stocks, the NASDAQ, which are typically technology stocks. Nothing wrong with owning ETFs to kind of invest in the market that way.
Ron Gross, good talking to you.
You too, Chris. Thank you.
As always, people on the program may have interest in the stocks they talk about, and the Motley Fool may have formal recommendations for or against. So don't buy or sell stocks based solely on what you hear. That's going to do it for this edition of Market Foolery. The show is mixed by Dan Boyd. I'm Chris Hill. Thanks for listening. We'll see you tomorrow.